I came across this piece of research by Douglas Westwood today. It was presented to Columbia University's School of International and Public Affairs on February the 11th, 2014. The presentation is available online for free. I don't agree with all of its conclusions, however, there was one chart that was presented which was so disturbing to me in its implications that I decided to make a video to share my thoughts. And here is the chart. It looks innocent enough, but it conveys a very powerful message. It summarizes the capital expenditures of all of the major listed independent oil companies, as well as their total production over the period covering the last 12 years. Capital expense is covered on the left-hand side of the plot, and the production is plotted on the right. On this slide, the presenter summarized in bullets the most important points, namely that production has fallen in the face of greatly increased capital expenditures. These are certainly valid points, but the importance of the chart and its implications can easily be missed if we don't dig a little bit further. So let's take a look a little bit more closely at CapEx. CapEx is very important because it represents the total spend on new capital and equipment, whether it's major expenses involved in keeping plants and rigs running, or expenses involved in putting new plants and rigs on the ground for the sake of expanding production. Because the oil and gas industry is so capitally intensive, CapEx will be a major factor in determining the price of oil. We can see from the chart that the capital expenses in the year 2000 were about $50 billion per year. Over the past 12 years, they've risen to over $250 billion per year. This is more than a five-fold increase in 12 years, and is a compound growth rate of 15% per year. Over 12 years, the oil majors have spent over $1.7 trillion to maintain and increase production. But as we can see here, production has hardly budged. Yes, it grew some during the first half of this period, but then it started to go into decline. So despite the huge capital investments made by the majors, it hasn't resulted in an increase in total production, at least not a meaningful one. But many will say that the reduction in crude production is in response to the global recession we seem to find ourselves in. It seems like a reasonable argument to make, but take a close look at when the peak in production took place. It was in the year 2006, a full 2 years before the recession really took hold. No, I don't think it was the crude oil companies cutting back in production due to lower demand that's causing the production rate decline. It's likely the other way around, that the oil majors just can't produce in the same amount of oil that they used to. And this is resulting in higher prices that are creating the recession. In other words, I think many people, including our central planners, are getting cause and effect reversed. And if you want extra proof, look at the capital expenditures. I can tell you right now, as an insider, that executives in the industry do not take the decision to make significant capital expenditures lightly. Their end-of-the-year bonuses are highly dependent upon return on capital. So that said, if it was reduced demand for the oil that is the result of lower production rates, then why would oil company executives be continuing to spend vast sums of money between the years 2006 and 2012? In the face of reduced demand, the logical course of action would be to curtail expenses. No, clearly it is the rate of conventional energy production that is weakening the economy, and not the other way around. So why do we see this increase in capital expenditure? Well, it's quite simple. As existing conventional wells become depleted, it requires greater amounts of capital investments just to stay still. Offshore production is much more capitally intensive than inland production. Still more expensive are less conventional sources of oil, such as oil sands and shale oil. But the problem is that oil companies have to make a return on their capital investments in order to stay in business. And so, in the face of stagnant rates of oil production, what is it that needs to change in order to make sure that these companies remain profitable? You got it. Price. And so, notice that starting in 2002, the rate of price increase of oil has averaged 15.3% per year. This is remarkably similar to the 15% per year rate of growth in capital expenditures. And on the surface, this appears to be sustainable. As oil becomes more expensive to find and extract from the ground, and the oil companies need to invest more money to produce it, all they need in order to make a profit is to pass along the cost to consumers. But it's a little bit more complicated than that. Think about it this way. The energy companies pass along their higher costs of energy extraction to the end users. But who are the end users? They are not only the ordinary citizens who fuel up their cars and drive to work, but the industries who make the capital equipment that needs to be deployed by the oil industries. As oil price increases, the price of the steel beams go up. The price of transporting equipment from one location to another goes up. The price of erecting the equipment goes up. The price of carbon and stainless steel vessels goes up. And on it goes, creating a vicious cycle where one impacts the other and vice versa. Sooner or later, you reach a point of no return where it just isn't economic to produce energy anymore. But where might that point be? We can see from this chart that at present, the new capital required per year just to keep this game going consumes more than half of the revenue from the oil produced. And this is with currently high oil prices. And this picture leaves out all of the other costs associated with producing oil, such as labor, the energy required to extract it, the energy required to find it, and the energy required to transport it. We're facing a pivotal time when the costs of producing new oil are becoming prohibitive. The rate of capital expenditure increase necessary just to stand still is causing a rapid rise in energy costs. This will eventually cause further rapid increases in the costs of capital. What's more, eventually the higher prices will affect consumption rates, which will make it even more difficult to justify going after the most expensive of the oils. And so in summary, the chart in the Douglas Westwood presentation is further evidence that we're facing the end of the era of cheap oil. Capital intensity is 5 times higher than it was only 12 years ago. Despite the high rates of capital investment, production rates of the majors appear to be in decline. The price of crude oil will need to continue to increase to compensate for this, and so we can expect our recession to only get worse. But the recession is the result of this phenomena, and not the cause, as is evidenced by the peak in the production occurring well before the recession, and by the fact that the capital investment continued to increase despite the decline in production. Policymakers have gotten it all wrong. They are fighting this trend by printing money. This can't and won't work. All it will do is cause the price of everything to increase. It will in no way fix the problem of oil being too difficult and too costly to produce. And so, as investors, we need to act accordingly. We should avoid any investments that require a growing real economy in order to do well. Traditionally, in an environment such as this, bonds would be a great investment because they do well in a contracting economy. And they have done well over the past decade. But eventually, the money printing and subsequent price increases are going to hurt bond investors. Stocks, despite their recent run from 2009 onward, are similarly a bad long-term choice. Precious metals are probably the best choice because their cost is tightly tied to the cost of energy. If you take a look at some of my older videos, you'll see that this is a consistent theme. For 45 years, the price of the 4 major metals have varied within a fairly well-defined band relative to the price of oil. And so let's take a look at current valuations. For 45 years, 1 ounce of gold, 50 ounces of silver, 0.75 ounces of platinum, or 2.5 ounces of palladium have purchased anywhere between 10 and 25 barrels of oil. I've plotted on this chart how much this quantity of each metal can buy presently. All but palladium are at the low end of the channel. Silver and platinum appear to be the best priced right now, with gold being priced a little bit higher. As a short-term speculation, I think silver and platinum can be good buys, but personally think that there is some risk involved. Silver and platinum are industrially important, and so if the economy continues to contract with higher energy prices, it's possible that demand for these metals may trail off. So my recommendation is to spread your risk. Don't limit yourself to only silver or only platinum, or even only silver plus platinum. Carry a healthy percentage of gold as well. I'm personally mostly in gold, but that's a personal preference based upon the risks that I'm willing to take.